Okay. Hi, I'm Peter Rose, founder of Longwood Currency Trading. Dangerous Forex trading expectations. Man, if you don't understand reasonable expectations behind your Forex trading, you're going to lose your money. There's two major causes of, I feel, of losses in trading, and this is one of them. If you have an unreasonable expectation of your ability at anything, it's going to be dangerous for you. If you're a race your car and you have unreasonable expectations of how good of a driver you are, not so much your car or anything else, but how good of a driver you are, you stand a real high probability of crashing that car and becoming seriously injured. You have to understand probability of life in general and the purpose of looking at standard deviations of abilities across the board in any discipline that you're involved in to try to place yourself within what standard deviation of ability are you capable of. There's a lot of people that are delusional. Well, we have to be very, very careful about our view of our abilities and a view of ourselves. I teach day trading, for example, and a lot of the people that I talk with say, oh, I don't want to do day trading. I want to do long-term position trading. I want to do set and forget. There's too much work at the day trading level. Well, look, there's too much work in trading at all, so you have the wrong attitude as to why you want to do long-term position trading as opposed to day trading. You're looking at it the wrong way, and therefore you're perhaps developing a bad expectation of what your capabilities are and how you're going to go about resolving those capabilities. This is just really critical stuff. I'm 75 years old. I've been around the bus on this stuff in many different disciplines, and I'm speaking with that expertise to help you understand that you can have very dangerous Forex trading expectations. There are two keys to the resolution of dangerous Forex trading expectations. They're very simple keys. Key number one is trade for pips and not dollars. And key number two is trade for a reasonable number of pips per position. Now, we have to dig into those and define the terms. Trade for pips, not for dollars. In other words, you don't say, oh, I'm going to try to make $200 today. Well, if you're trading a mini account at $1 a pip, that's probably not going to happen. If you're trading a one full lot, you make $200, you make how many pips? You're going to make 20 pips. If you had a $100,000 account and you were going to trade, you'd need 2 pips. Is a $200 return against a 10 pip, $100 a pip bank, 10 pips, 10 lots say, is that a reasonable return against, well, if you do a 10-to-1 leverage, it's a $100,000 account to trade 10 pips, so you divide $200 by $100,000, put at risk for the 10. Is that worth getting up in the morning for? Is that worth trading when you have 100,000 or 70,000 or whatever it is that you're at risk, and you make $200 for the day on that? Certainly, making $200 a day is trading over the full 200 days that we have available. We have more than that, but that's basically the accepted thing. It gives you some time off. Is that a reasonable return against your money? Well, no, it isn't. So that's the next step of the thing, which is trade for a reasonable number of pips per position. And then that takes the dollar ego out of it, because you could sit down and say, I want to make $500 a day. And you're pushing a one full lot position, or maybe even a 2 full lot position to make that $500. Well, if you could make $500 a day on average over the 200 trading days, it's $100,000 on your 2 lot account. That's just not reasonable. So that number of pips that you're trying to get, 50 pips or whatever it is, that's not a reasonable number of pips. You're trading for pips, not dollars, so that you take the ego out. Oh, I'm going to trade I've got this bank and I'm going to trade for $300 a day or $500 a day. Or if you have, a large account, you can say, I want to trade for $4,000 a day. But is the underlying number of pips on the positions that you're taking, is that reasonable? Well, and key two is the one that we want to spend some time talking about, because when you sit down to look at all this stuff, first of all, you have to know how much leverage you're trading with. If you're trading 500 to 1 or 200 to 1, like so many of these advanced traders are doing, they're trying to tell you that that's what you should do. Sure, there's some of you that are going to come out great. You're going to make $100,000 a year. Good luck to you, because you had not only the expectation, but you also had the innate ability to do that. I could go in and go for a software engineering job, and they're asking me what my database experience is, and I can say, oh, I've been database administrator on a 4,000 user database. Then you get hired for the job. You go into the station of life that advanced salary is paying you, and then you can't produce, and they go, you're out of here. Now you can't pay your mortgage. So when you're looking at trading for number of pips, you have to be reasonable in what your trading ability gives you the ability to get that number of pips. I always start students out trading at 10 to 1. If I'm going to trade one mini lot at $1 a pip, you have to have $1,000. If you're going to trade a full lot at $10 a pip, you have $10,000. If you're going to trade 10 full lots, you need $100,000, $10,000 per lot. That's risk management. And you can't make as much money trading that way as you could at 200 or 100 or 500 to 1 leverage. But that leverage comes later in the trading, not during entry. You have to work up all these metrics based on entry, because if you can't get through your entry, or you lose much more money on entry stops than you make when the trade is successful, you're never going to get to the position management or the exit methodology phases of the life cycle of a currency position that I've defined. And I've defined that through my software engineering background, is that these are the three problems that you need to solve in trading: entry analysis, position management, and exit methodology. If you can't get through that entry analysis stage, you don't have a position to manage. So when we're looking at the leverage is 10 to 1 at entry. Can you change that? Yes, but it doesn't come at entry. And you shouldn't even have that in your head, because it's not applicable to you as you're trying to build metrics and process and your rules. I mean, I talk to guys that have been trading for years and they're semi-successful. They're just looking for a way to get more money out of their trade. And they think that trading for higher leverage is the secret sauce to their success. And it really isn't. I mean, if you want to drive your car in a stock car race, you can't buy it off the lot as a stock level car, a family car, and go on the stock racing circuit. You have to juice up that engine. Well, I don't have the money to juice the engine up. Then you can't fucking race the car. So if you want to make more money in your trading, you have to have more money. Not, oh, I'm going to make more money by trading for more pips. This is the key rule number 2. And it's not 2 in order of importance. It is the rule. Trade for a reasonable number of pips per position. As I was saying earlier, when I start a student out, it's $1,000 bank and $1 a pip. So now it's really easy to say, oh, are you going to make $200 a trade? Well, no, I'm not. Well, what's reasonable? $50? Well, that's 50 pips. Can you do that? Probably not. Well, how about 2 pips? Could you do that? Oh, yeah, I think I could do that. How about 3 pips? Could you do that? Yeah, I could average out 3 pips. I should be able to average out 10 pips. Yeah, but we're just getting started. We're trying to build process and metrics. Could you get 5 pips? I could get 5 pips. I could make $5 a day. And I think I could. Some days I'll get 10, some days I'll get 20, some days I'll get 3, some days I'll lose 20. But I think I could average out 5 pips a day. See, that's why I can only be of help to somebody who has about a year of trading and a live account, at least 50 to 100 trades, because then you can talk, I can talk to you, and we could be reasonable about what you're trying to accomplish. You've been trying to make 50 pips at 200 to 1 leverage, and it's just not happening. You got a $20,000 account and money's going out the door like crazy. Let's settle down here. Let's look at $1,000 and $1 a pip. You make 5 pips. You make 0.5% on the position on average. 0.5, 0.5%. And you think, well, $5, that isn't going to do anything for me. No, it isn't going to do anything for you. But 5 pips on a $100,000 account, trading at $100 a pip, that's $500. But it's the same 0.5% return against the $100,000 account as it is against the $1,000 account. It's the same percentage. It's 0.5%. Except when you trade a $1,000 account, it's only $5. If you trade a $100,000 account or 70 or whatever you need to trade 10 lots, it becomes $500. And $500 times $200 a day, that's $100,000 a year. Boom. That's how you make more money and have reasonable expectations. Once you get to the point where you're saying, I can make 8 pips, that's the best I can get. Well, that's $160,000 a year then with a 10 lot. So let's look reasonably at the number of pips per position that you can trade. You say, well, 5 pips a day isn't enough. No, it's not 5 pips a day. It's 5 pips per position. So you may make, at the higher lot level sizes that you're trading, you may make 3 trades or 3 transactions to build your position of 3 transactions and then close that out. And then you may take another trade and one trade in the position, 1 transaction in the position, and close that out. There are 2 positions. One had 3 transactions to it and the other one only had 1. You have to think in terms of position, not trades. A trade is something that you do. A position is something that you have. There's a big difference of that, and I've rarely talked to anybody that understands that nuance. So 5 pips per position is 0.5%. If you're a really good trader, even a day trader, you could do 3 to 5 trades a day. So if you're making 5 pips per position, 3 to 5 positions a day, even I get scrambled up because if I use these terms and people don't understand what I'm saying, then they think that I don't know what I'm doing. So I talk in terms of trades so people can understand. Let's say I'm an all-in, all-out trader, so I'm only making 1 transaction to create that position, and I get out. Now that position could be, I go in with 3 lots, and I come out with 3 lots. I go in with 50 lots, and I come out with 50 lots. Doesn't make any difference. It's 1 transaction creating 1 position. If you're trading a mini lot at $1 a pip, and you make 5 pips, you make $5, 0.5% on that position. If you did 5 pips on average, every position that you take, then if you take 4 positions a day, you'd make 20 pips. Oh my God, you'd make $20. So if you're trading 1 full lot, you'd make how much? $200. If you're trading 10 lots, you'd make $2,000. So that's why you need to learn to have expectations on a per position basis, because then you say, oh, if I can do that good, then I'll just do more of them. That's the key to the thing. Now, are you able to do that if you're a long-term position trader? You're going to put your position on and you're going to hold that for 2 weeks, 3 weeks, and you're going to hope to get 300 pips, 400 pips, whatever it is, 500 pips, whatever you can strangle out of that. You divide the time that you've held that trade into that profit, and now you have a per day value that trade is. Why couldn't you do 2 positions a day for that same amount of period for a far less number of pips? How much would you make? And how much safer would that be? So you have to look at how you're trading. If you're doing a long-term position trade on a 2-lot position, that thing is going to have to go 700 or 800 pips in order for you to make enough money to justify what's going on. So why not day trade, where you can take many positions the same day and achieve more pips per day, not on a position basis, but more pips on a daily basis. So we're looking at what's reasonable for the number of pips that per position. And when I'm working with someone, I can say, let's make $5 a day on the $1,000 account. Let's see if you can do that. Because if your entry analysis is wrong, you're constantly going to get stopped out and you're going to be underwater. Maybe you're 40, 60 underwater. You win 4 times, you lose 6. Or you win 3 times and you win 3 times and you lose 7 times. You're 70, 30 underwater. You need to learn that. It isn't, oh, my stop is too short, or no, it's you. It's you. You have to learn how to develop more winning trades than you do in losing trades, and lose less when you lose than you win more when you win. That's the key to identifying what a reasonable number of pips per position for you will be. You take 10 trades, you don't have a very good sample size. You take 50 trades or hopefully 100 trades. How long is it going to take you to do 100 trades if you're a long-term position trader, to develop your metrics, to see how good of a trader you are? It's impossible. I don't know how you're going to do that. But over 100 trades, you can do 100 trades. You take 2 positions a day, 5 days a week. That's 10 positions a week. I mean, in 10 weeks, you're done. You've got a good sample size of trading. Of course, you have to know what you're doing, right? You do have to know what you're doing. So in looking at your number of pips per position, you have to say, what's easy for me to get every time I do a position? Because easy is what you want. You want to be able to trade in any market condition, in any circumstance, and say, okay, I'm in, I've got a good entry process so that the price is moving in my favor. How far is it going to move? Is it going to get to my profit target? The profit target isn't a profit target in day trading. The profit target is only how far the expectation is that price will go based on other conditions surrounding you. You're not looking to make your profit target number of pips per position. If I set my profit target at 20 or 30 pips I'm not expecting to make 20 or 30 pips on the position. I'm only saying the position has the capability of going 20 or 30 pips, but I'm only looking for the number of pips that I'm capable of making over the long period of time. And how do you determine that? Well, these are things that I work with students in the coursework, because we're solving the problem of entry analysis, and more importantly, what is a reasonable number of pips that you should be able to trade for your ability level? What's the metric that determines your ability level? We have to work on that metric. We have to work on your analysis of that entry, and we have to nail down in you the fact that the reasonable number of pips that you should make on a day, that you should get every time you make a winning trade, you always should be able to get this. Once that number starts to creep up as to the number of pips that you're able to get per trade, it means that your entry analysis is getting better and better, that you are identifying the good places to take that trade such that it does have the momentum to move an average number of pips. Maybe you'll find that your sweet spot is 10 or 12 pips. Maybe it's 8 pips. Maybe it's only 3. It doesn't make any difference. You have to know what that reasonable number is, so that when your price is moving in your favor and you get you have a 5 pip expectation, you know that's easy for you to get, and the price gets to 8 pips, you lock the profit at 5 pips. Oh, but that's only a 3 pip run to your stop, and I get stopped out when the price may move. Yeah, but if the price doesn't move, you'll make 5 pips. And if the price is, if you've really evaluated that position correctly, then that price that's moved to 8 pips should continue another 8 pips before it has a retracement in the price. And all you're doing is tracking the stop behind that, constantly gathering more and more pips before you get that turnaround. And that's a balance that I work with in my students' coursework, to identify the variables that are involved here in that analysis that you're doing. And then when you get to advanced trading, if you take my advanced solutions course, then you're looking at staging, building positions and staging positions. Where do you stage? How far from the last stage point do you stage to the next one? How many lots do you put in? Where do you put your stop behind that? What's the average distance requirement between where your average price is and where current price is, so that you know all those things. You multiply once you start staging and building in more lots into the position. The complexity of the problem becomes magnified. And if you don't have a good process for dealing with that, and you start trading multiple lots and then start losing, you're losing multiple lots, when before you have built up your bank to trading single lot all in, all out, or single position all in, all out, you're gonna lose. You'll have winning trades that will go against you, that you will turn into large losses, unlike when you had single transaction positions that you were doing. So trust me when I say that the root of all that is having dangerous Forex trading expectations with no foundation of rationality behind them. You have to really soul search yourself. And if you have questions about this, feel free to email me. I'd be happy to chat with you about it. No charge. No, I'm not trying to sell you a course or anything. Even if we had a video conference so that I could help you with an individual problem, I'm certainly willing to do that at no charge, because why would I have you take a course when all you've got is an individual problem? You solve that problem, boom, you're all set. But if you have multiple problems and you're asking all kinds of questions that are logical questions to ask, that shows that you're ready to actually learn how to trade well, that you don't know how to trade, that you have more questions, then we could talk about a course if you want. But I'm not going to try to sell you the course. Either you are interested in it, you think there's value there for the price, and you buy the course, or you don't. But I'm not going to sell it to you. I'm retired. I don't need to sell courses. I'm not running a training business. It takes time away from my coffee drinking. Be very wary of having dangerous Forex trading expectations, and by identifying what reasonable expectations are, you will be much more successful at your trading, and I hope this video has helped you. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.